how did a bunch of Reddit users push a stock price up by 10,000%? Now, you don't usually hear the words memes and financial markets in the same sentence, but on Wednesday, everyone was talking about Wall Street Bets, a subreddit that collectively raised the price of GameStop stock to such an extent that it nearly bankrupted billion-dollar institutional players. This video is broken down into two parts. I'm going to talk about the background of what happened and then the implications. So if you want to jump right to the implications, I'll put the time code in the video description. Okay, let's dive in. What do you need to know? Well, first off, what exactly is Wall Street Bets? So Wall Street Bets is a community on Reddit that posts news, memes, personal anecdotes, general discussion topics about investing, stocks, and the stock market. But it's not your average investment forum. It's chaotic. There are lots of jokes, lots of GIFs, lots of memes, lots of weird lingo that we'll get into later. And the community self-describes as if 4chan got a Bloomberg terminal illness. Users call themselves degenerates, and that's just the vibe. This is a place where bragging about your losses gets as many upvotes as making good investments. Now, for the most part, the community is made up of amateur day traders between the ages of 19 and 40 who use sites like Robinhood in order to make their investments. And this is a community that has grown a lot over the past year, in large part thanks to the pandemic. With so many of us forced to stay at home, day trading and surfing the web is a pretty good way to pass the time. And since January of 2020, the community has added an additional 1.3 million members to its ranks. So how does GameStop, a video game retailer, factor into all of this drama? Well, the idea to invest in GameStop has actually been around since 2019, when Reddit user Deep Effing Value posted about purchasing call options for GameStop. Now, when you purchase a call option, you are buying the right, but not the obligation, to buy a share of stock at a future date at a predetermined price. So I can say I want the option to buy stock X at $10 a share in March of 2024. And if on that date the share is worth less than $10, well, then my options are sort of worthless. But if the stock is trading at a higher price, like say $30 a share, then I can turn a profit because I'm paying $10 for something that's valued at $30. And that's what DFV did with GameStop. In 2019, he purchased the options to buy GameStop stock in 2021 for $8 a share. And then he doubled down by purchasing a variety of different options for various 2020 and 2021 dates. Now, focusing on one single long shot stock bet is called a YOLO move in this community. And in total, he placed about $53,000 worth of options. Now, he made the case that supporting GameStop was a good idea, pointing to the fact that Chewy.com founder Ryan Cohen had recently joined the board as a good indication that the company could turn its decline around. And when the stock hit $10, the rest of the community started to take note and they started buying shares too. In mid-January, the stock price rose by 60%, and suddenly the hedge funds that had bet against GameStop started to speak out because they thought that this was a business that was supposed to be dying. And some of these institutions made fun of retail investors, calling investing in GameStop dumb money and catching the ire of the Wall Street Bets community. So users pointed out that, hey, many companies had shorted the stock and they speculated that if they pooled their influence and if they created this artificial demand to force the stock price up, it would force those big companies to recalibrate their bets and force those investors that didn't have the money to cover their losses into financial trouble. There was even a post discussing all of this called Bankrupting Institutional Investors for Dummies featuring GameStop that was posted outlining this entire thing. So for context, you should also know that Wall Street Bets has had a contentious relationship with big institutional investors. Many members of the community are millennials that entered the job market at the height of the 2008 financial crisis and saw firsthand the devastation that was unleashed on the economy with little to no consequences for many of these banks. So when they had an opportunity to get back at some of these large players, they did. So they kept buying stock and the price kept going up. By 2021, that $53,000 of options that have been purchased by DFV is actually now worth $22.8 million. The result is that now the hedge funds that had bet big against GameStop suddenly had a financial crisis of their own on their hands. So take Melvin Capital, a hedge fund that purchased $55 million worth of put options on GameStop. Now, put options are the opposite of call options. It's a contract that lets you sell a stock at a future date at a predetermined price. So Melvin's analysts predicted that the stock would fall, so they purchased the option to sell that stock at a higher price, hoping to be able to make a profit. But thanks to Wall Street bets, the stock went up instead of down, meaning that those $55 million of put options were now worthless. And to make matters more complicated, many institutional investors had also shorted the stock, meaning they had speculated that the price would go down and had borrowed shares from another investor for a fee, hoping to pocket a profit when the share price dropped so that they could buy the shares back at a discount. Because I'm not a financial expert, I'm going to quote the New York Times here, where they say, quote, "If the stock rises, the short seller is exposed to losses that are theoretically infinite. Because when a bet goes wrong, short sellers rush to repurchase the shares they borrowed so that they can return them and exit their trades, a process that's known as covering." Basically, by increasing the price of the stock, Wall Street bets forced the hedge funds who were short selling to buy back the borrowed shares at a higher price than they had budgeted, which also pushed the stock price up even higher. And this had some pretty hefty consequences, as Melvin Capital had to take a $2.8 billion bailout in order to cover those bets. So now let's talk about what all of this means from a digital culture perspective. There are three things I want us to think about. One is, how are the rules of platforms facilitating trading? So many of these transactions were done on Robinhood, a no-fees investment platform that has removed a lot of the barriers of entry to investing and caters to young first-time investors who can, with a click of a button, make trades on their phone. So now you have a whole new cohort of investors that couldn't access the market before. Now, Robinhood has faced its share of controversy. The app is accused of gamifying investing by turning it into a social activity. So like, for example, if you get a friend to sign up, you get the chance to win a share of high glamour stock like Apple. Critics of the app have warned that by making trading so easy, it minimizes the consequences of losing money if you invest in the wrong thing. And there are a lot of stories of people losing their college funds and their savings in the rush to make money on the stock market. So now here's where it gets tricky, because in light of all the volatility around the GameStop stock, Robinhood stopped users from being able to purchase any stock at all, a movement that has already resulted in the filing of a class action lawsuit against them. Now, as this plays out, we're going to have to grapple with the increasingly influential role that platforms have in the stock market, both in terms of who gets to access the market and what they have access to. The second thing is, this highlights the power of online coordinated groups, because there's no reason why the tactic that was used by Wall Street bets on this particular stock couldn't be used on other stocks as well. Now, this could have a longer-term impact on investment strategies used both by institutional and retail players. Because suddenly, the game changes when a group of individuals can challenge the position strategy of billion-dollar companies. Now, something to keep in mind here is, while the community did act as a collective, their reasons for doing so aren't all the same. Yes, some users did want to stick it to the hedge funds that they feel have profited without consequence, but others just wanted to get in on the fun. They just wanted to pump up a meme stock. They just wanted to do it for the lulz because it was amusing. The truth is there were a lot of different reasons people participated. The last factor to think about is who is influencing who. So Tim Hwang on Twitter raised a really interesting question, pointing out that much of Wall Street bets and Reddit are run by anonymous accounts with aliases. Reddit subs work on a system of upvotes and downvotes with the idea that the community can decide what the most popular post should be. Tim's worry, and it's a legit one, is how do we know who is controlling the upvotes and the downvotes? Because according to his analysis, it only costs about 9 cents per account to create a bunch of dummy accounts solely for the purpose of manipulating these metrics. Now, this raises a bigger vulnerability of communities that operate on trust-based systems like this, in that they can be hacked. So what happens when a community has the ability and the incentive to move billions of dollars based on the encouragement of a few anonymous accounts? The continued mainstreaming of meme language just demonstrates the growing influence of digital culture. and organizations need to start paying attention to what's happening in these online spaces. I mean, when you have mainstream news outlets having to explain internet slang to investors, then you know that we have reached a new milestone. And for the record, because I always want you to be forearmed with the latest information, a stonk is an intentional misspelling of the word stock, and it's used in memes usually along with this guy, who is known as Meme Man. And these memes generally poke fun at the financial industry. Now, other slang includes things like rockets or to the moon, which is what a lot of people were saying about the GameStop stock, and that just means that you want that price of the stock to skyrocket. You'll often see the rocket emoji and the moon emojis being used in this context. Now, what happened with the GameStop stock is a great example of the impact of online communities on financial markets. And while some people might say, oh, it's market manipulation, a lot of the legal analysis that I've been reading says that that might not be the case, because everything that was discussed on Wall Street Bets was done so in the open and online for anyone to see and participate in, rather than in shady backroom deals. Now, tech has lowered the barriers and allowed individuals to move with a collective power that was normally reserved for these big institutions. And this has shaken up a hold on market dynamics that have governed investment strategy for a long time. But on the flip side, because of this, a lot of people have been able to pay off student debts, mortgages, even pay for surgery. Now, if you're interested in learning more, I've got a Medium piece that goes into some further readings, as well as examples of other instances where technology has been used to manipulate markets, including, for example, the ICO pump and dump boom that was done on Telegram in 2017. So thank you so much for tuning in, and I'll see you next time.